Okay, good morning, everybody, and welcome to this K3 Hub tax update webinar. My name's Marie Wadeson, and for those that haven't met me before, I'm a Managing Director at Quantuma, and on behalf of our parent company, the K3 Capital Group Plc, I'm also responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched last year, over 2,100 like-minded members across the country have joined the network. And through the K3 Hub, you can access benefits such as a range of CPD and training sessions such as today, and referral fees for certain types of work referred into our group. Okay, so in today's session, we are covering off-payroll working, 1 year on since legislation, steps engagers need to take as soft landing comes to an end, how off-payroll working is being considered as part of tax due diligence. And finally, we'll end up with a roundup of recent high-profile cases. Before I introduce our speakers today, a couple of pieces of housekeeping as usual. So Q&A function is open. Please do feel free to use it throughout today's session. Today's session is going to run for about 45 minutes. We've got a lot of content in there. We're going to hold all questions until the end. We've got about 15 minutes for questions then. Because we're covering a fair few different subjects, it will be, and we're keeping the questions until the end, it would be really helpful if you've got questions about very specific things that one of our speakers has said, if you could give me a little bit of context so I get your question correct at the end and we can kind of refer back to what we were saying at the time, that would be incredibly helpful for me. If for whatever reason we get too many questions and we're not able to cover them in the time that we've got allowance today, don't worry. What I'll do is I'll pass your questions and your contact details on to our speakers and they will come back to you directly. And finally, this session is being recorded and will be uploaded onto the K3 Hub website, probably the beginning of next week now. Okay, so on to our speakers then. So I am very pleased to be joined by my colleagues, Scott Campbell and Kayleigh Everson from K3 Tax Advisory, which is a sister company of Quantuma's and a fellow K3 Capital Group company. Scott is a employment tax director. He advises on both UK domestic and international employment tax matters. And amongst other things, his experience includes helping employers implement new payroll policies, advising on employment tax related issues arising from due diligence. It's actually been touch and go whether Scott's will be able to join us this week. He's actually had COVID, not been very well, still not feeling his best, but I'm very pleased that he's been able to make it this morning. And Kayleigh is a tax manager at K3 Tax Advisory, specialising in employment, international and private wealth taxes. Kayleigh's clients include startups, multinational corporations, government bodies and sports teams. And it's very exciting today. Kayleigh has gone global and is joining us from Budapest, where she'll be working for the summer. So, Scott, I'm going to hand over to you first.
Great, thanks, Marie. Is it possible to get the first slide up, please? Okay, so off-payroll working, we're over a year into it now. So, why is it important for us to be thinking about, and what's the purpose of doing a presentation on it today? And I think that the key point here is, because we are well over a year into it now, the potential tax exposures are starting to accumulate and are starting to become material now for a business, particularly where they're using multiple contractors. You can find that the potential exposure is really racking up. And I use the term material on purpose because when we're thinking about off-payroll working, the threshold test for a business to have to consider off-payroll working mirrors that of the threshold test for an audit. So we're looking at the £10.2 million of turnover, the 5.1 million of assets, or 50 or more employees. And so you're in a position now where you've got the potential for non-compliance to result in really significant tax exposures, but also a business that is required to undertake an audit. And so the auditors are going to be starting to look at these material exposures and questioning the business's compliance with off-payroll working and what procedures and what processes they've got in place. And away from that audit piece, you've also got the fact that the soft landing from HMRC that they introduced as part of a relaxation to when the legislation first came in, that's come to an end now. So practically what it meant with the soft landing is that they weren't going to push for penalties for non-compliance in 21-22, where there was where it wasn't a case that there was deliberate non-compliance. And in addition, we saw a fairly light touch around enforcement action on businesses. HMRC were giving them time to bed in their processes around off-payroll working. But clearly that has come to an end now, and that's why it's again becoming important to think about off-payroll working. And so what's the cost for getting it wrong? And I mentioned there's an exposure there. Well, simply it is the income tax loss to HMRC. So as a minimum, you're looking at a 20% basic rate tax cost. In addition to that, you're going to have a national insurance charge, and that will be both the employee element of the national insurance and employer. So you're looking at a 25% or just over 25% tax charge on national insurance alone. So we're getting very close to the exposure being 50% of the fees that have actually been paid to the contractor. And that's with a basic rate taxpayer. We know that a lot of contractors working through their own limited companies tend to be paid quite significant sums. So a lot of those individuals will be in their higher rate tax band. So the exposure is getting even higher. Plus, for the current year, we've had the introduction of the social care levy. So we've got an additional 2.5% charge on the national insurance side as well, thinking about, again, both employer and employee contributions there. Added to that, and for 2021-22, this would have applied as well. So while HMRC gave a soft landing around penalties, they didn't give the soft landing around interest. Interest would still accumulate. Now, when we're thinking about HMRC settlements, it's easy to overlook the interest because for a number of years it's been a historic lows. It's not really formed a chunky part of the settlement figure. But what we have at the moment is the highest rate of interest since January 2009. And the way the interest rates are going, it looks like that's only going to get higher. So the interest will start to become a more important factor in the overall settlement. I said before that HMRC aren't charging penalties for 21-22, but as we look at the current year, they are going to be looking to charge penalties. So what are those penalties? Well, the penalties are tax geared and are on the same basis that we've seen with other taxes. So you're looking at the sort of penalties up to 100% of the tax loss for deliberate and concealed. And while most of the circumstances that we will see non-compliance, it's likely to be in that careless category rather than the deliberate. You're still looking at penalties up to 30%. So if you've got someone who's a high rate taxpayer and you've got a penalty charge and your interest and your national insurance, it's very easy to get to a position where the overall cost of that settlement and exposure to the business is actually almost identical to the fees that have been paid. You're looking at roughly around 100% of the cost of settling with the revenue versus what you've actually paid to the contractor. So that's the real cost and the real crux of the cost for the business and not getting their compliance correct. And before I go on, I just wanted to touch on, and we've commented very briefly on HMRC enforcement and the fact that we haven't seen all that much enforcement in 21-22 around this legislation. And as I said, part of that is because HMRC have wanted to give businesses time to bed in their process dealing with off-payroll working. But in part, it's also a hangover from the pandemic. And speaking to someone who's got COVID at the moment, I know there has been a lot of COVID-related absence, but also HMRC staff have been diverted to other areas within HMRC, looking after the CJRS, for instance. But what I would say is what we're seeing now is normal service and has now resumed largely, and HMRC enforcement action is likely to ramp up this year. Where do I see their priorities being? I think for me, it's going to be the low-hanging fruit, and industries and businesses that rely heavily on contractors are probably going to be the first targets of HMRC inquiry. So those sorts of business are, it's construction, it's IT, it's financial services, it's oil and gas. Those are going to be the main areas where we expect to see HMRC targeting their inquiries initially, at least. Okay, I think on to the next slide if I can, please. So what do engagers need to do, and what do they need to think about now that soft landing's come to an end? And I think taking a step back here and think before we look at what the minimum compliance is just reminding ourselves, actually, why is off-payroll working being introduced? What is the change? And essentially it comes back to the IR35 legislation was designed to avoid employment status issues where people are using limited companies to circumvent normal employment status legislation. The problem that legislation had is all the obligations were on the contractor, and HMRC estimated that we had a non-compliance rate of around 90%, 90. So that wasn't good enough. So they wanted to shift the onus onto the engager. And essentially that's what has happened. The engager now has the responsibilities for determining the employment status of limited company contractors. And what does that mean in practice? Well, it means that they have to review all of the contractors that are being used by the business and then issue what's known as a status determination statement to the contractor to confirm their status. Leading up to April 21, we saw a massive push from engagers in ensuring they were complying with the off-payroll working legislation, and that they were making their assessments and they were issuing them to the contractors. I think the concern for me is that many businesses saw this as a one-time exercise. They invested a lot in the run-up to April 21 to make sure that happened, but they haven't necessarily thought about the ongoing process and the need to think about off-payroll working on an ongoing basis, rather than just that one-time exercise that they had to do back in April 21. And for me, there's two parts to this process that businesses need to put in place. First is to think about, okay, that they're going to be using new contractors, and new contractors are going to come into the business, and have they got a process in place now to monitor when new contractors join the business and ensure that the assessments are done on them at that point and issued to them. And then separately away from that, you've got a number of contractors, pre-existing contractors, who have perhaps been working for the business for a number of years, but certainly since April 21, where the business had historically done the assessment and fulfilled their compliance obligations. But because the contractor has been working with that business over a period of time now, have those assessments started to lapse? You know, are they still relevant? Do they still reflect the reality of what's going on in the working practices between that contractor and the business today? And if not, then that assessment's no longer valid and needs revisited. And I know, again, leading up to April 21, that there was this massive push to get the assessments done and issued to contractors, and businesses where they had significant number of contractors were actually resourcing to role-based assessments to circumvent the need to look at individual contractors on a case-by-case basis to speed up that process. And while that might be acceptable in some circumstances, the concern I have now is that the labour market has changed since where we were last year, and it's really hard to recruit people into the business and to get contractors to come and work for them, particularly if the business is putting restrictions in place to ensure that everyone's working exactly the same way. And the reality of what's probably happening is exceptions are being made to those role-based assessments. You know, they're bringing contractors in and tweaking the terms of engagement to get that contractor on board. But the problem then is that they're not thinking about the assessment and the need to undertake a new assessment, because those role-based assessments probably don't reflect the reality of how that contractor was engaged and are invalid. So there's a risk of challenge there from HMRC. So I guess the overall point I'm making here is, and the best advice I can give, is that businesses are putting in place a procedure that incorporates a review of all contractor assessments, whether they be new to the business or long-standing, and reissue the assessment and the status determination statements to the contractor on at least an annual basis. And that is really, and we're coming on to evidence and records in a second, but that having that evidence that actually you haven't just looked at it at the start, but you're continuing to look at it at least once a year is a very good piece of evidence to have should HMRC raise an inquiry into the business. So thinking about evidence, the first point I wanted to make here is not actually evidence that you're gathering around the contractor. It's the evidence that you've got to demonstrate that the individual within the business is the right person to be making the assessment and raising the determinations. You know, there are many functions within the business that perhaps could take that responsibility on. You know, you can imagine quite easily that the HR function in the business, they're responsible for all the personnel. They could arguably have the responsibility to make the decision. Equally, you've got the finance function. You know, they're the ones that are probably have the most technical knowledge around employment status. They will also probably have the most knowledge around actually the payment structure for the contractor and what they're being paid. So arguably they could be the best person to make the assessment. Equally, it might be actually the person that's driving the project on, the project lead, that the contractors were going to be working on. You know, they're the ones that are at the coalface. They know how the working practices look and how the contractor is going to be engaged. So surely they should be involved. There's an argument there. Unfortunately, the legislation doesn't stipulate what and who should be undertaking the assessment. All there is within the legislation is this overriding obligation to ensure that appropriate care is taken when making the decision, and that the decision is an accurate reflection of the engagement. The problem with that is that we could get to a position where we see HMRC arguing that the individuals who are making those decisions aren't qualified enough to make the assessment. So going back to the example that I just talked about was the HR individual, you know, it would be very easy for HMRC to argue, well, actually, the HR team have no technical knowledge to be able to make that decision. They shouldn't be making that decision. Equally, for the finance function, they say, well, actually, you're not close enough to the engagement. How do you know how this contractor is being engaged? They shouldn't be making the decision. And again, with the project lead, it might be argued that they don't have sufficient technical knowledge. It could also be argued that they're too close to the project and they're too driven by ensuring that that project meets its deliverables, that they will bend to the whims of the contractor to give them the assessment that they want to ensure that the contractor stays on board and completes the work. So that puts us into a catch-22 position. You know, who should be making the decision? And for me, there's three options here that sort of as a best practice. And the first is to say, well, it's not the responsibility of any one individual in the organisation, and have multiple individuals feeding into that. So you can see a role using that previous example where actually all three of those functions, the HR, the finance, and the project, all feed into the assessment to make that assessment. And that sort of approach would be very robust and very hard for HMRC to argue against. If there isn't the ability to incorporate multiple people into making that assessment, then actually think about providing some training to the person that is making that assessment. So if it's the project lead that's going to be undertaking the assessment, you know, invest some time with them, perhaps have your accountant come in and sit down with them and talk through employment status factors, so the upskilling their technical knowledge to be able to make that assessment. That might be a way of demonstrating that you've taken appropriate steps. And finally, the other option would be to think about outsourcing the responsibilities to somebody who is a technical specialist in this area that can ask the right questions and ensure the assessment is made correctly. So away from actually thinking about who should be making the assessment, what evidence do we have that contributes to support the decision that's made? And for me, and I know there's a number of lawyers on the call and they're thankful for saying this, but the most important piece of evidence that you have, your primary evidence, is going to be your written contract. And the important thing here is to ensure that that written contract reflects the actual working practices in the business, because it is your first line of defence from any HMRC challenge. And if it doesn't reflect the reality of what's going on, HMRC are just going to cast it aside and look at what's going on the day-to-day. And this is an area I can't stress enough, and I know it's something that Kayleigh is also going to touch on in her case roundup. But I wanted to illustrate just how important a contract can be with a live example that I've got at the moment. And in this case, my client set up a business where they were going to make use of their extensive contacts and help them negotiate business transactions. The work they were doing was a regulated activity, and they had experience from doing this with a former employer. They had quite a good relationship with that former employer. The former employer had offices very prestigious offices in London, and as well as having a back office function that included sort of a debt collection team and an in-house legal counsel. So there's an agreement between the former employer and my client that my client would use their business to piggyback off of their regulatory registrations, to use their in-house legal counsel, to rent some office space from them, and to use the business to help collect all of their debts in from the income that they're generating. In return, the client agreed to pay the business a payment each year of £250,000 for use of the office space. And on top of that, they would allow the business to keep 25% of the income generated that they're collecting. So it all sounds very good. The client was very successful. They ended up needing to recruit a couple of full-time employees, one as a personal assistant, another who was focused purely on business development and finding new clients for them. And the business also used a variety of contractors, which they paid substantial sums to help them with these business transaction negotiations. There was no control over my client by the former employer. They didn't have any control over the clients that were engaged, how, when, and where the work was done. It was all the responsibility of my client. In addition, my client had extra costs from employment, not just from the employees, but there were significant amounts of travel costs, both domestic expenses and overseas travel. For reasons unknown to me, the client agreed to sign a written contract with the former employer, but the former employer used an adapted version of an employment contract as the basis of the contract, with my client's personal service company being the employee in that situation. And this contract had beared no reflection of the working practices. What we saw were clauses around personal service, clauses around the need to undertake an annual health check, admission into a phantom employee shares. There are all sorts of things that just bear no resemblance to what was actually going on in practice. I asked my client, why would he sign such a contract? And he said, well, in all fairness, I knew I had all the power of the relationship, and any of the provisions in that contract just weren't going to be enforceable. So I had no concern about signing it. Fast forward a few years, and HMRC opened up an inquiry, and it's an inquiry that I've been dealing with for the last 3 years. Last week, we finally had an opinion from HMRC, and they deemed the engagement to be within IR35, largely based on what was in the written contract. And they've completely ignored representations that have been made by my client and the former employer that reiterate the working practices as I've just described them. It's everything in that opinion. It's a 12-page opinion, refers to clause X in the contract, clause Y in the contract. So the message here is the contract can be your first line of defence, but it really needs to reflect what is actually going on in practice. And if it doesn't, then you're in trouble. And it's not just the contract that needs to be updated when, it's not just the assessment that needs to be updated when the engagement evolves over time, like we were talking about earlier, but it's also the contract. You need to make sure that that contract is always an accurate reflection of what's happening and what's going on. Away from the contract, I just wanted to touch on some of the other records and evidence that might be relevant to an engager to gather in. And these will differ from business to business and industry to industry. But clearly, if you're relying on questionnaires from the contractor or the project lead or the manager overseeing the contractor in making the assessment, then keep copies of those questionnaires because they are your primary records. Equally, if the project is a site-based project, if you've got people that are going to site and doing a site visit, are they reporting back? And if they are reporting back, what comments are they making about the contractors in those reports? And keep records of those reports, as they may demonstrate, that there is no control over the contractor. They turned up on site and the contractor wasn't there because they worked to their own schedule. And similar provisions, if it's not site-based, if there's a project update meeting and there's minutes from those meetings, keep those meetings. Another area might be signing logs, and it might be if the engagement is taking place in the engager's offices, or again, it might be on site-based. Who's signing in on those logs? Is it the underlying contractor? Are they bringing helpers with them? Are they sending substitutes? Those sorts of records can be really helpful when proving your case and defending the case. Equally, if the engagement isn't relying on just labour and there's an element of plant materials that the contractor is bringing, do you have a record of what plant materials were used in delivering that project? If not, ask the contractor for, because that then helps substantiate the decision that you're making. Okay, so I think that probably covers everything on that. And can I go on to the next slide, please? Okay, so thinking about something slightly different now, and I've said already that with HMRC's enforcement activity, it's been fairly limited to date, so we don't have a lot of experience around how HMRC are going to challenge the off-payroll working. But what we have seen a lot of is obviously businesses that are being sold and buyers' concerns being raised around off-payroll working. And what I would say as a very broad statement here is that the usual tax indemnities and warranties that we see aren't sufficient. Buyers aren't happy to say, okay, we can put a tax warranty in place and tax indemnity in place for this. They want us to undertake a detailed review of compliance around off-payroll working. They want to understand what compliance has taken place, what non-compliance is there, and what's the potential exposure from that. So that's an area where that there is a lot of concern, and I think perhaps with exception for the CJRS, off-payroll working is where we're seeing most of the queries raised and concerns raised from buyers around employment tax due diligence at the moment. So we've already touched on the small exemption in the sense that there is this ongoing requirement to think about it each year and ensure that you haven't reached the threshold each year. And so many businesses might be thinking, okay, well, I may be being sold, but off-payroll working doesn't apply to me and the business is too small. But they need to remember that actually you've got to look at those thresholds each year. And they may have breached those thresholds last year and should have been applying the legislation from 6th of April this year, in which case it's taken them by surprise that they haven't done anything around off-payroll working, they haven't issued any assessments, and finding they're in a position of non-compliance. So it's remembering that you need to revisit and re-look at that each year. And the other point here is that while even in situations when the business may be some way off of breaching those off-payroll working thresholds, it can still be a concern for buyers on due diligence, because what will happen post-acquisition is that business will be incorporated into the buyer's business and or group, and at that point they're coming into a much bigger group, and when we think about the off-payroll working thresholds, we must look at them at a group level. So businesses are finding that actually it's important to make sure that the management of the business understand what they need to do around off-payroll working and employment status more generally. What are their records? How many contractors are they using in the business to help them prepare for the requirements post-acquisition? So I think it's fair to say that even if the business isn't at that threshold, but they are thinking, we're going to have a sale soon, they need to be thinking about off-payroll working. Where non-compliance has been identified as part of tax due diligence, one point I would make here is that buyers are taking a very hardline approach. They are insisting that the business makes amendments to their FPS reporting if the errors have occurred in year to ensure that compliance is brought up to date. Where the errors relate to last year, they're looking for voluntary disclosures to be made, and in many cases are looking for amounts to be held in escrow until a settlement has been reached to HMRC. So again, going back to the point that I made previously, the tax warranties and indemnities aren't usually sufficient to cover it. They're looking for specific allowances and provisions for potential off-payroll working exposures. One final point that I want to make before I hand over to Kayleigh is around office holders and non-execs. And it's surprising how much of an issue this is still being when we're looking at tax due diligence. You've got HMRC assessed, so check employment status for tax tool. And one of the very first questions that tool asks is the individual an office holder in the business? And if you answer yes to that, very quickly you get to a position where HMRC will say it's within the scope of IR35 or off-payroll working implies. And to see so many businesses that are engaging with office holders off payroll, either on a self-employed basis or through their own limited company, is really surprising, given that there are very few exceptions when that can happen without creating a deemed employment charge. So that's one area where we know there is real concern. That's probably everything from me for the moment, and I'll hand over to Kayleigh.
Thanks, Scott. If we could go on to the next slide, please. So in this final part of the session, I'll be talking through a roundup of some high-profile cases that have been through the tribunals in the sort of last 6 to 9 months. In summary, it's not been a very good time to be a high-profile TV or radio presenter taking an IR35 case to tribunal. In the 6 cases I'm looking to cover, you'll see there's only been one taxpayer win. There's been a substantial shift in the court's approach. COVID-19 has had a significant impact on the courts, mostly through to delays. We're seeing judgments come through now on cases that were initially heard as early as back as 2018. And as you can imagine, this is leading to significant costs to those taxpayers looking to fight their cases. There have been some cases where the entire judgments needed to be reheard, where the judges become unavailable. There does seem to be a shift in the approach of the court away from substance over form. And it's something that we as tax advisors relied on quite heavily historically. I'll talk about the auto-cleanse case in a bit more detail, but they're certainly placing more weight onto the actual written agreements rather than looking through to the working practices. A key message that's coming out of the case review is that the written contract does need to be watertight, and that it needs to match the actual working practices of the engagement. The example Scott gave earlier is a classic case of what is now going to be an uphill battle in order to argue that we need to look at the actual working practices. Contracts should be being reviewed regularly. We're seeing cases where there's been one contract in place for various years, even though that engagement has changed. And then just finally, we're yet to see any cases go through tribunal for the updated off-payroll working rules. As Scott mentioned, it's been a soft landing. It takes a number of years for cases to get to tribunal. And so it'll be really interesting to see if the current approach carries on For example, where in DD we're seeing a failure to pass down a status determination statement down the contractual chain, I think there'll be little hope in arguing that the reality of the engagement was everybody involved knew that that person was outside of IR35 or inside of IR35. If the paperwork is not in place, that's really going to be key. If I could have the next slide, please. So the first case is the only successful case of the 6 I'll be talking about. This is Basic Broadcasting Limited, Adrian Charles. It was a taxpayer win at the first tier tribunal. It's a first tier tribunal case, so it's not binding. And the judgment was on the 7th of February 2022. So as background, Mr. Charles provides services through Basic Broadcasting Limited to a number of engagers such as ITV, BBC. He does radio shows, he writes columns for newspapers. He also does a number of unpaid services through Basic Broadcasting Limited for the period that's in question. HMRC raised an inquiry into the 2012-13 to 17-18 periods, and there was £1.7 million of tax at stake. Unfortunately for Mr. Charles, the case was actually first heard in 2019. The judge contracted long COVID and had to retire, so the entire case had to be reheard, which is why we're only now just getting a first tier tribunal judgment. What the judge did find at the first tier tribunal was, as I mentioned, through Basic Broadcasting Limited, there were a number of engagements with different parties. None of them were full-time contracts, and none of them vetoed him from working for anybody else. Not only that, he had a number of sources of income coming through Basic Broadcasting Limited, and he used a management company that's charged 15% of any fees raised as part of promoting his business. Looking at the secondary factors, he had a home office. He was not found to be integrated to either the ITV or BBC contracts. He sought out his own work and he co-produced his own show. The judge found that nothing was demonstrative of an employment contract, and so actually he was found to be outside of IR35. The key thing was he was in business in his own account. He was able to financially profit from sound management, and he was never part and parcel of the organisation. So this is an example of somebody structuring their affairs correctly through a personal service company and genuinely in business on their own account. Next slide, please. Kickabout Productions Limited. This is a favourite case of mine, simply because of the backwards and forwards we've had over the years. So this case has finally gone to the Court of Appeal after a number of years being seen at both first and upper tier tribunals. Unfortunately, it was a loss for the taxpayer at the Court of Appeal, and this judgment will stand and will impact future IR35 cases. This was concerned with presenter Paul Hawksby, who provided a radio service through Kickabout Productions to TalkSport. I understand he had a very long-standing engagement with TalkSport over a number of years. There were a few contracts, but largely the contracts weren't updated. The assessment related to 3 years. Initially it was 4, but one of them was settled quite early on in the tribunal process. 2012-13 to 2014-15. And actually, when looking at the financial position, 90% of the income into Kickabout Productions Limited and then down to Mr. Hawksby was from TalkSport for the periods in question. The first tier tribunal actually decided that IR35 did not apply, and this was formed largely on a perceived lack of control from TalkSport. They judged that Mr. Hawksby, through Kickabout Productions Limited, was fully in control of how he produced his radio show, what he covered, and so they found that the engagement was outside of IR35. But the decision was not unanimous, and it was appealed at the upper tier tribunal. The upper tier tribunal then went back to the written contract, and they found a clause that stated that KPL was obliged to offer Mr. Hawksby's services for 222 programmes a year. And therefore they concluded that there was mutuality of obligation. There was definitely a personal service required, and therefore it was found to be inside of IR35. Kickabout Productions legal team put forward 4 rounds of appeal, the main one being that the upper tier tribunal erred in its interpretation of the contracts with regard to the obligation of TalkSport to provide work. But unfortunately, on review, the judge decided that none of the claims met the threshold, and so the upper tier tribunal stands, and that one will be decisive going forward. So the key takeaway is that the contract was really what caused this engagement to be inside of IR35. Can I have the next slide, please? On the same date, we also got the Athol House Productions Limited case through. Again, Court of Appeal. I've listed this one as a partial loss for the taxpayer. It's very interesting how this one's come about. So this was Kay Adams providing a radio service through Athol House Productions. Initially, HMRC raised the inquiry into the services she offered to the BBC through her personal service company. The inquiry was taken to the first tier tribunal, similar to Kickabout, where it was found to be outside of IR35. Now, this was back in 2018, and thinking has shifted since then. The 2018 case relied heavily on the underlying practices rather than the written contract. And the judge quoted from the Autocleanse Limited and Belcher case, which looks to set aside the written contract in favour of actual working practices. HMRC appealed the case when it was found to be outside of IR35 and took it to the upper tier tribunal. Now, the upper tier tribunal agreed with the first tier tribunal, and so she was still found to be outside of IR35. However, the upper tier tribunal determined that the first tier had erred in its decision-making with regard to looking at the contract, but when it looked at the principles enlarged, so our mutuality of obligation, our personal service and control factors, it found that she was still outside of IR35 when looking at that hypothetical contract. Now, HMRC raised an appeal to this and said that we shouldn't just be looking at whether she's in business in her own account. We need to be looking at the primary factors. And the Court of Appeal have allowed this appeal, and so this case is going to be reheard, I think, at the upper tier tribunal again. And it'll be very interesting because the judgment actually says that they can no longer rely on the Autocleanse Limited and Belcher case, which means that they cannot look through that initial written contract between Athol House Productions and the BBC. So I think when this gets reheard, we may find that there are some clauses within that contract that were initially set aside that might deem her to be within inside IR35. Can I have the next slide, please? Alan Parry Productions Limited, a first tier tribunal case, a taxpayer loss. In the most recent of our cases, we had this judgment just under a month ago. Alan Parry was providing his services through his limited company to Sky B as a sports commentator. A number of years in question, 13-14 to 18-19, and £356,000 of tax at stake. HMRC had contended that based on the contract, again, Sky had control over whether Parry could provide services to others, so Sky had a right to veto other engagements. Additionally, they provided equipment to him. He was considered part and parcel of the organisation, had limited financial risk, and had a long-standing relationship with Sky. I think he's worked with Sky on and off for about 18 years. The contract also indicated that Sky could not terminate the engagement without financial penalty. And for one event where he was unavailable to provide his services, Sky was able to select the substitute, not Alan Parry Productions Limited. Therefore, looking at all of these and based on what was in the written contract, it was deemed to be an employment relationship. We're yet to see whether this one will be appealed. They're still within the time limits, and so it's a case of watching this space. Can I have the next slide, please? McCann Media Limited. I do like this case. I think it's quite interesting. This is a first tier tribunal taxpayer loss from March 2022. Neil McCann was providing his services through his personal service company, again to Sky B, as a football commentator. Again, the written contracts were reviewed here, and they found that despite McCann disputing the nature of the engagement, that he simply charged for services that he performed, they found that he was charging a fixed monthly fee regardless of whether he was commentating. And actually, during the periods in question, he was appointed the manager of Dundee FC and stepped back from any work from Sky, and yet still continued to send them monthly invoices. Sky had the right to veto any substitutions that he was to provide, and therefore it was deemed to be a very strong personal service and control, and therefore inside of IR35. And next slide, please. And our final case is a little bit of an older one, but I think this one was very unfortunate for the taxpayer. So I wanted to include it to show you how you can do all of the right things, but still get caught by small details. Little Piece of Paradise Limited was Dave Clark's personal service company, through which he provided his services as a sports commentator for darts. Heard back in October 2021 at the First Tier Tribunal. Very similar to McCann Media, actually, Little Piece of Paradise was seen to invoice for services where none were performed. The judge said this indicated that it was an annual fee rather than a per performance invoice. Sky maintained control over whether he got to interview people, how much on-screen time he had, whether Sky even hosted the matches on their viewing platform. And so that was seen to be a measure of control in the case. Now, really unfortunately for Clark, there was an opportunity for a substitute to be given. He went through the steps to provide a substitute, but unfortunately, when it came to engaging, instead of engaging through Little Piece of Paradise Limited, the substitute chose to engage directly with Sky. And the judge said that that was enough to mean that the substitution was not as strong as it should have been. And it seemed to be quite an important factor in this case. So I suppose that just rounds up these cases. The change in the auto cleanse Belcher case is going to be really important going forward. We can no longer rely on, well, okay, yes, that's what the written contract said, but here's what actually happens in practice. It's gone from being your first line of defense to something that can make or break your case when we come to tribunal. So really, yeah, cannot stress enough the importance of a tightly worded contract that reflects the working practices. And I think that's probably about it from me. Back to Marie for questions.
Thank you, Kayleigh. That was great. Thank you. Very comprehensive. Couple of questions have come in. So one for you, Kayleigh. You talked earlier on about form and substance in respect of the cases going to court. So this is actually one from me. So direction of travel for the courts, I guess for the remainder of this year into next, and then recommendations for the advisors on today's call who are sort of looking out for the interests of their clients.
Yeah, of course. So if we were having this call, say 12 to 24 months ago, the taxpayers were on a bit of a roll in the courts, and we are now seeing that reverse. So there's definitely a change in approach. As I said, the Attle House Productions case came down very hard on that auto cleanse v Belcher judgment, and they said that, I think actually I have some wording here, let me yeah, so the judge said that there was a dispute in relation to the application of the IR35 legislation with respect to the auto cleanse no longer being authoritative in determining the terms of the actual contractual arrangements, which basically means for any future IR35 cases, they're no longer going to apply the principles that were set out in the earlier case. So before, we were always looking to set aside any written contract that just wasn't reflective of actual practices, but now it seems that that written contract will be taken as rote. There's no necessarily setting it aside. In terms of what advisors on the call should do today is review those written contracts where you can. Obviously, you can't rewrite history, but any steps you can take now to get a correctly reflective contract in place should be taken.
Great, thank you. Okay. Right, I've got one here from Andrew. So Andrew asks, we have a client given an out of IR35 contract who was asked to indemnify the engager for costs if HMRC raised an assessment on them relating to the contract. Scott, I think this is one for you. How enforceable is this?
So there's a couple of points to make there. So Kayleigh is absolutely right, and that HMRC are putting an increasing focus on the contract. If the contract doesn't reflect the reality of what's going on and it works in the HMRC's favour, you can guarantee that they will look to cast it aside and focus on the working practices still. So the contract, having an IR35 proof contract, actually what's going on in the working practices does that IR35 proof of contracts reflect the arrangement? So is there a real risk that this indemnity that they're looking for is going to be enforced at some point? And then on how enforceable is it? Well, when it comes to the actual tax exposure and HMRC collecting the exposure, they're not going to be interested in any side agreement that the contractor has with their engager. They will be pursuing the engager for the liability in the first instance. Obviously, how enforceable is the liability once the engager's paid it on the provisions that have been agreed between the contractor and the engager? That comes down to the written agreement, and I guess the ability to pursue that contractor. I know separately there are various organisations that are offering IR35 insurance that may protect the exposure and will pay out in circumstances where HMRC have deemed there to be a breach of the rules and an exposure. But this sounds like it's something slightly different to that.
Brilliant, thank you very much. And then one final question from Robert, so coming in two parts. So Robert asks, is there any suggestion that the thresholds will be reduced? And then goes on to say he's thinking specifically of dental practices that use dental associates, i.e. non-equity self-employed contractor dentists.
So I guess 2 points here. So the off-payroll working legislation only applies to limited company contractors. So if you've got self-employed dental consultants, then they are still potentially, there is no de minimis, there is no threshold for them. So you need to look at the reality of what's going on there, and there is the potential for an employment status challenge there under normal employment status provisions, remembering that IR35 is essentially just anti-avoidance legislation for employment status where somebody's using a limited company. So on that first point, there is no threshold for employment status. If they are self-employed consultants, then you need to be thinking about the potential exposures. If they are limited companies, but the dental practice is below those thresholds, then all of the obligations as they are at the moment sit with the consultant dentist rather than the engager. On the point around whether or not we're likely to see the thresholds reduced, I don't think it's out of reach to think that they will be. There's no suggestion at the moment that they're going to be. But what we have seen when I spoke about that 90% non-compliance rate under the old IR35 rules, what we have seen is this change to off-payroll working has really increased compliance and increased the amount of tax take that the revenue are getting from IR35 type related issues, or encouraging contractors to go on payroll as employees. So the tax take is up as a result of this legislation. So because of the positivity that's come from HMRC's perspective, the positivity that's come from this change, you could see it as being something quite conceivable that they would want to drop the thresholds at some point. But at the moment, I'm not aware of any sort of rumours that that's going to happen.
Very comprehensive. Thank you very much, Scott. Right, well, that brings us to the end of the technical part of this session. So just a couple of things from me. So this is the K3 Hub's last CPD and webinar session for this side of the summer. The team who diligently run these sessions in the background, namely Helen and Caroline, we're going to take a break over the summer. We have a very packed schedule for K3 Hub members in September, and if we've not already been in touch about what we've got planned for you in terms of webinar and CPD sessions, we will be in touch very soon. Thank you very much to today's speakers, Scott and Kayleigh from K3 Tax Advisory. If you wish to get in contact with them, their contact details are on the screen now. So all that's left for me to say is thank you very much to the very many people that have joined us today. Thank you very much for your company and for humouring me this morning. We're grateful to you all, and have a great summer. Thank you very much.
Thank you.